This is not a friendly market. It's not a particularly fun market. It's certainly not a market that makes you want to buy any stocks. It makes you want to sell them. But as I told you last night, it would be the height of irresponsibility to sell everything. Trimming, yes, but to sell everything, no. Because it's very possible that at some point there will come a time when Washington reaches a deal to fix the fiscal cliff. And you absolutely do not want to miss that moment. Even after today, it was clearly discouraging to think we're nowhere near it. It's worth hanging on just for the possibility, though, that there will be some gains, but not to every stock. The question is, what should you hang on to? Tonight, I'm answering that question by throwing a surprise party to celebrate the stocks that are worth buying here. No, not a typical surprise party. I don't mean a party that's a surprise. It's way too gloomy for that out there. I mean a party for companies that have reported fabulous upside surprises. Yet, thanks to this recent sell-off, the stocks are actually trading below where they were when the earnings came out. If that's not a bargain, I don't know what is, provided that the company can do well in a recession that's caused by the fiscal cliff. So, let's get with it. Take GNC Holdings. GNC, for you home gamers, the vitamin store chain with more than 7,800 locations around the world, including 6,000 right here in the U.S. This is a classic play on the healthy living theme we've talked about many times here on Mad Money. Healthy living, I think you still want to do it even after the cliff happens. And back on November 1st, GNC reported what amounts to a triple play. First, the company delivered a 3-cent earnings beat off a 58-cent basis. Second, GNC's revenues beat Wall Street's expectations, too, rising 15.5% year-over-year. Then third, CNBC gave upside guidance, the forecast. Higher than expected earnings and revenues for the full year. Good forecast. That's the triple play. Those were some excellent results. One of the very few companies that were able to run that gauntlet, according to some excellent research put out by the good people at Bespoke Investment Group, which actually tallies up all these surprises and looks for the biggest ones. You would think that GNC checked off all the boxes necessary to go higher. Earnings beat, revenue beat, guidance beat. But in fact, the stock got slammed after these numbers came out. Before the quarter, GNC was trading at $38.67. The day it reported, it dropped about a point. Since then, the stock has fallen as low as $34.57 today, down $4 or more than 10% since its upside surprise. 10%, okay? So a little bit more than the S&P has fallen since the peak. So what did go wrong here, if anything? Why has GNC been crushed despite posting some terrific numbers? First of all, you have to understand that going into earnings, the stock had run up 34% for the year, which meant the expectations were high, and GNC was in a prime position to get clubbed if there was anything wrong with the quarter. Now, on Wall Street, when a company reports perfect results that are absolutely flawless, we say the quarter has no hair. Because bald is beautiful in the world of finance, if not the country that is Cramer. GNC, though, had a little teeny bit of hair. It was some peach fuzz. And that could get rid of, you can get rid of that with some depilatory, or some of the lasers they use today, the Groupon deals you get every morning. But the market disagreed. The first piece of hair was GNC's loyalty card program. The current program hasn't been changed in years. The way it works now is that GNC's customers pay $15 to buy the card. It gives them a 20% discount on most products in the store during the first week of every month. This is a bad way to run a loyalty program. But even with this cumbersome model, loyalty card purchases account for 60% of GNC sales. I was surprised it was that high. Now, here's what people got all hot and bothered about. At the moment, GNC is testing right now a new version of its loyalty card program in several markets, which works more like a supermarket loyalty club. You buy the card and you get a separate lower price on virtually every item every day, but not 20% lower like the old version. About a third of the chain is now on this new model, and GNC expects to transition the majority of its stores, or possibly the entire chain, by the end of next year. Problem is that this new loyalty card has created a level of uncertainty about the future of GNC's gross profit margins. Some analysts are worried that it could cap the company's earnings upside by giving people too many discounts. In other words, while this quarter may have been an upside surprise, a lot of people are worried that the new loyalty card will lead to downside surprises in the future, despite the guidance, which was so positive. The other issue with the quarter had to do with GNC's same-store sales. The analysts were looking for a 12% increase at domestic company-owned locations, but GNC only posted a 9.8% increase. Even as the same-store sales at their franchises, they rose 14.3%. In absolute sense, these numbers were stellar, but they were lower than expected, and that was enough to take the wind out of GNC's sales. Even more nitpicky, when you look at the same-store sales on a 2-year stacked basis, they seem to be decelerating. And we know the company's up against tough comparisons going forward. All I can say about this is that if GNC missed the street's same-store sales targets but still blew away the earnings estimates, I don't know. To me, management's executing superbly. There aren't many that have been able to do that. Final negative. This really hurts. Last week, GNC did an 11.73 million share secondary offering so that some of the shareholders who took it public last year could sell. The deal priced at $35.20, which is now a little less than a point above where the stock is trading, okay? But aside from the insider selling, which I am never crazy about, but doesn't necessarily mean things are going awry, I think these negatives are bogus. Let's go through them. GNC delivered a very strong quarter. And you're now getting the stock for $4 less than where it was reported. To me, that's the most salient piece of information out here. Not only that, but at least one of the reasons people sold GNC was actually a reason to buy. This new rewards card program. We've studied this. Forget the anomalous worries about what it could do to the gross margins down the road. GNC has already rolled out the darn thing in a whole bunch of locations, and the results are positive, not negative. In the markets where they're testing the new program, it's already leading to higher growth in transactions. And each time the program is implemented, it leads to a pop in same-store sales, for heaven's sake. The gross margin, okay, it takes an initial hit of about 200 basis points when they stop charging $15 for the card and start giving it away for free. But the store made it back from the raised price structure. GNC is not JCPenney. All right, it's not Costco either, but it's not JCPenney. They wouldn't switch to a whole new discount model if they didn't have evidence that it would make them more money. Why would they commit financial suicide? These are smart guys. Plus, GNC is rolling out a host of new products during the rest of 2012 and the beginning of 2013. They just launched a new sports nutrition line in partnership with Mark Wahlberg called Marked, and their online business is growing like a weed. Traffic up 35% in the last quarter. GNC is cheap. After the latest sell-off, it's trading at 13 times next year's earnings, but it does have a 22% long-term growth rate. That's a very strange anomaly. I know a lot of growth managers who would be willing to pay 20 times earnings for a stock with that kind of growth. Here's the bottom line. GNC, it did report, I mean, maybe we forget because everything's so gloomy now, a triple play, better than expected sales, earnings, guidance. Yet its stock went down for a bunch of nitpicky reasons. And now I think you can leg into it, as GNC, a non-economically sensitive play, should begin to bottom not far from here, as I described with other stocks at the top of the show. Remember, almost nothing's going higher right now, but recent history of Armageddons teach us that some stocks break their declines ahead of others. I gotta tell you, I think GNC, it fits the mold. After the break, I'll try to make you more money.
Don't go anywhere. The celebration is just beginning. Cramer's got another.
Oh, it's a surprise. An upside surprise. I know you don't care, but I'm begging you not to let the lousy state of the market blind you to the fact that there's still plenty of real worthwhile opportunities out there, and some are getting quickly to prices we might actually like, even as we approach the dreaded cliff. I know there are a lot of disappointments in the latest quarterly period, like tons of them, but there are also some winners. And many of the stocks that reported good numbers are now rising above, but they're being obscured by worries about the fiscal cliff. And that's why we're throwing our surprise party tonight here on Mad Money, where I highlight companies that delivered upside surprises, but have been neglected, severely neglected. They've been overlooked. And they've actually seen their stocks go lower. And don't forget, I expect Home Depot, Cisco, maybe even PetSmart in a couple days to go lower because of how horrible this market is. The good people at Bespoke Investment Group went through all the companies that reported in this earnings period, and they tallied up every one that ran a very tight gauntlet, not unlike the one that Clinton ran. In Arizona. The company had to beat Wall Street's earnings estimates, it had to beat the revenue estimates, and it had to give guidance that beat the expectations of the analysts. Tall triple play order. And you better believe this was not a long list. And most of the companies I still didn't like. But any company that makes it on here, you know what? It's doing well. So we looked over this group of companies that had made this amazing triple play, especially amazing when you consider the difficult environment. And we searched for the ones where the stocks were not getting the credit they deserved and can still do well in a recessionary environment that we will get into if we go over the fiscal cliff, which looks increasingly likely. After the president made it pretty clear today, I felt that talks aren't going hot and heavy. Hey, that's how I came with the GNC, which I recommended earlier. And now I have another neglected triple play name for you. It's... Have I overdone this yet? No more than I've overdone the fiscal cliff. Although, of course, it's been right to do. Anyway, it's CVS Caremark. the giant household name pharmacy chain with roughly 7,300 stores. It's also a pharmacy benefit manager, or PBM. Yeah, we're having a birthday cake, surprise cake. Ooh, it's one of those ones that has its ice cream in it. Look, first of all, everybody knows what a pharmacy does, right? Right? I mean, the fiscal cliff hasn't got you that clouded yet. You still know what a pharmacy is. But a pharmacy benefits manager? A little more arcane. CVS got into this business back in 2007 when they bought Cramer. Basically, PBMs manage prescription drug programs for everybody, from insurance companies to HMOs to regular businesses, using their bargaining power to help their clients get lower prices for drugs. But CVS Cramer is unique in that they're the only pharmacy benefit manager. Geez, this kind of bogus fork to give me here, that has also its own major league pharmacy. Now, CVS reported back on the morning of November 1st, and like I said before, it had run the triple play gauntlet. The company earned 85 cents a share, beating the estimates by a penny. Its revenues came in at a bit more than $30.2 billion, up 12.12% year over year. Hey, that's $140 million better than expected. I'm calling that a gigantic beat. And CVS's full-year earnings guidance also surprised the upside. Drilling down further, the Cramer pharmacy benefit side of the business was on fire. It beat the company's previous guidance handily, with operating earnings up 19%. On the retail side, CVS same-store sales were up 4.3%, also above their previous guidance of 3%, thanks to strength in the pharmacy end of the store and to the beating it delivered to competitor Walgreens, which it is just really taking it to. Yet, despite these strong results, CVS barely budged the day it reported. It was almost as if someone took a Bowie knife and stuck it into the upside surprise party. It's even worse. Stock's actually come down since then. Before earnings, CVS was trading at $46.60. Now it's at $45.41. By the time you watch this and then wait for it tomorrow, probably at $44. Well, wait a second. Stock's way down from its highs. It was at $49 last month. That's an 8% decline. Pretty much big move for a large cap company like CVS, equal to what the S&P's going down. What the heck is going on here? Why is CVS being punished after performing a rare triple play during a generally disappointing earnings season? Was there some hidden negatives below the surface that poisoned the whole quarter? Well, look, when the market's going down, we always find negatives, right? Was the conference call really bad? No. CVS is being held back by worries that don't make much sense to me, and of course is being brought down by the same old. First, some people are concerned about the broader macro situation. They think that if we go over the fiscal cliff, a weak economy could damage CVS's business. I don't know. Can we just stipulate that the pharmacy business is the last place you stop shopping in a slowdown? I'm not going to some cheaper toothpaste. I'm not going to forego toothpaste. I'm not going to lighten up on the medicine. And I think the stock is already beginning to overcompensate for the looming cliff. Looming cliff, one of my absolute favorites of the cliches that we've been using. I've been going with looming cliff today. Oh, and we heard after the bell that Warren Buffett's Berkshire Hathaway sold its CVS stake back in September, which, even though it was before all the good news, could weigh on the stock tomorrow. Second, CVS's stock has been hurt because of bad results with some of its competitors. On the pharmacy benefit management side, Express Scripts reported an absolutely dismal quarter. I mean, talk about a party pooper. What is these, titanium balloons? Well, anyway, that made people worry about Cramer. And on the pharmacy side, Walgreens reported disappointing numbers. People are extrapolating from Walgreens and Express Scripts and assuming that, therefore, hey, CVS must be bad too. That's insane. I mean, CVS just reported a terrific quarter. Their pharmacy benefit management business was especially fabulous. The obvious conclusion here is that CVS is taking share from the competition. Bad news for Express Scripts, and Walgreens is good news for CVS. Saw the same thing today when Juniper and Hewlett Packard were up off of Cisco doing well, and Cisco was killing them. I mean, come on. Innocence by association. Speaking of Walgreens and Express Scripts, they're a big part of the reason why I've liked CVS for so long. Last year, these two companies got into a dispute, which ended with Express Scripts removing Walgreens from its network at the beginning of this year, making it so 90 million Express Scripts prescriptions could no longer be filled at Walgreens. Oh, man, that gave CVS a fabulous opportunity to take share. Now, Express Scripts and Walgreens buried the hatchet back in July, something that caused CVS to drop $4 a single day. But it now looks like the damage was already done. Many of the customers who switched from Walgreens to CVS, they seem to be staying at CVS. The dispute between Express Scripts and Walgreens has been and remains a big win for CVS. Then how about this pharmacy benefit manager side? Oh, there it is again, the Express Scripts merger with Medco Health, which closed in April. Medco came with a lot of problems, it turns out. The integration issues from this deal could allow CVS Caremark to do better in the selling season for 2013 as they ramp up for the coming year. Just like Walgreens Express Scripts problems, this will be terrific for CVS. Company also benefits from the wave of branded drugs that are going generic, tens of billions of dollars worth this year and next year. Generic drugs are cheaper, but they also have much higher margins for the pharmacy benefit managers. And of course, Obamacare is going to happen, which should lead to about 30 million more people with health insurance who will need to pick up the prescriptions somewhere. Hey, you know what? It's probably likely to be CVS. Don't forget, it's flu season. Now, the flu season, fortunately, hey, knock wood, it's been pretty benign. Can you imagine? Here's the stock that's barely nicked by the fiscal cliff and by benefits from Obamacare, but they're putting it on sale anyway, like it's a stock that gets hurt by Obamacare and is crushed by the fiscal cliff. CVS trades at less than 12 times earnings, 13.2% growth rate. I think it's pretty cheap. Plus, CVS has an analyst day coming up on December 13th. I think management's going to tell a very good story. So I would begin, remember, I'm not telling you go in, begin to buy the stock into weakness ahead of that meeting. I'm forecasting the stock to be down another $1 tomorrow. Maybe that's where you start. You start with a little piece, not a big piece, a little piece of buying. Like maybe like something like this big. That should be your first buy. The bottom line, CVS delivered a triple play quarter. But with all the fear of the fiscal cliff, the stock's been ignored and actually going lower. You know what? I think that's crazy. Remember, all stocks are going down right now, but some are going to bottom well ahead of others. And CVS lies squarely in that sainted category. Try some. Ted in Oregon. Ted!
Hey, Jim, I want to give you a big booyah from Portland, Oregon, and say thank you for doing the show.
I'm liking Oregon football. I got to tell you, Oregon football's really good. Unfortunately, I got to stay up to 3 a.m., which is exactly when I get up in the morning. But go ahead.
Hi, my question to you is about Five Below, ticker 5. I bought the stock a few months ago and was able to get rid of it before the recent big drop. And I just read the company has been opening a lot of new stores, just got a new distribution center, and their earnings are coming out on December 11th. I'm wondering if this pullback is a good time to get back into the stock.
We're not in that kind of market anymore. The fiscal cliff is taking apart these kinds of stocks. So Five Below, let me tell you, I'm going to give you a really cynical reason why I don't want you to touch Five Below. And when I say cynical, it's not what you want to hear. And the answer is, just 1 second, drum roll, please. What happened to my drum roll? I got the rim shot. The stock is up gigantically for the year. Up gigantically. A lot of people have a double in it, or almost a double. They're going to ring the register. The fiscal cliff says you should. Darn it all. How about Andrew in Florida, please, Andrew?
Professor Cramer got a dim booyah from South Florida.
Nice. What's going on?
Well, what's going on is, okay, I'm calling about Michael Kors, ticker KORS. I'm lost. Yesterday, in my opinion, they delivered stellar earnings. The company absolutely crushed expectations and dropped my jaw. I'm asking you, do you think that Kors will continue to advance and be one of the few luxury brands to be invested heading into the holiday season?
All right, this is, again, I know this is heretical to those of us who do a lot of work. I'm sitting there last night, okay? I got no teams to root. I got no bait. I got nothing on whatsoever. And here I am. So I said, I'm going to go read the Kors conference call. Every page is better than the past. Every page looks great. I mean, it's like it's a really great episode of some TV show you like. But you know what? It sells at a gazillion times earnings. And everyone's got a profit in it. So people are taking profits. You have to wait until next year, unless we resolve the cliff before him. It's the Mad Money Upside Surprise Party, and you're the ones who are getting all the gifts. I'm picking stocks that beat the sales, beat the earnings, and beat the forecast that are somewhat recession-proof or do well over the fiscal cliff. And CVS delivered that triple play quarter, but you never know it. Fiscal cliff is sending stocks diving, but some will bottom sooner than others. This one's going to taste real good down $1.50. Go, Cramer.
Coming up.